Hello, and thank you so much for coming to your credit report and the down payment. Today's presentation is by Aaron Staufer, mortgage loan originator with Elevations Credit Union. And he has been in the industry for quite a few years at this point and is a great reference even for myself. And we're very excited to have him. One key thing for you to know, if you have any questions, you'll see down at the bottom of the screen, there is a Q&A option. So you can actually type your questions in and we'll be able to answer them aggregated over the course of our event. Thank you so much for coming.
Beautiful. Thanks, Kat. All right. So thank you for joining me for your lunch break. A little bit about me. So I've been in the mortgage industry now for 15 years. Prior to that, I had my real estate license. So this is kind of the business I was born and bred into. I really enjoyed it. It's a technical sales position, and it's got a lot of technical know-how, which I really like, and then also the sales aspect of it, which is also fun. So yeah, it suits me well. If I'm not doing mortgages, I like to go on rides on my motorcycle with my dog. Not that one, the other one. So if you ever see an Irish setter in a sidecar, that is me and Finn. I tried sticking the golden doodle in a motorcycle one time and it did not work out so well. She jumped out and ran away. So the first and last time I ever tried that. So yeah, let's get into it. So whenever you get qualified for a mortgage, lenders care about what we call the 3 C's. Okay, first C is credit. Credit is your credit score. We're going to be spending a lot of our time talking about your credit score today. What score do we look at? How can you improve your credit score? How can you get the most out of each aspect of your score? What are the big derogatory items that could hold a qualification back regardless of the credit score? We're going to be talking about all that. Second C is capacity. So capacity has 2 different components. One is your debt to income ratio. Okay, that is how much you make each month and then how much your debts are each month. And relative to that, we can figure out how much your mortgage payment can be on a given month. And then we also look at down payment. Down payment is your, what they call skin in the game. Okay, it's your contribution to the transaction. It's your personal contribution. We're going to be talking about down payment as well. Down payment assistance programs, what assets are okay, what assets are not okay. And then the last C is collateral, which is the property you're buying. Buying a house is a little bit unique in that the lender cares about what you buy. If you buy a car, the lender doesn't ask to see the car. They just simply say, how many miles are on it? What's the Kelley Blue Book value? Great, here's your loan. Well, when you buy a house, the lender absolutely cares about the house. So today's topic is on credit report and down payment. We're going to be focusing on these 2 specific components. So starting with credit. So in finance, it's rank order risk based on how well obligations have been paid in the past. If you've ever watched like a wealth management commercial of any sort, Fidelity commercials, whatever, they always have that little blurb at the end, which is, past performance does not guarantee future success, right? So it's kind of the same thing with your credit. Yeah, if you paid your bills on time in the past, it doesn't guarantee that you're going to do so in the future, but it's a pretty good idea. It's a pretty good trajectory. It's a pretty good basis to base the reliability of you paying your debts on time. If you've done it in the past, you're likely to do it in the future. So that's all your credit score is. When mortgage lenders look at your credit score, we look at what we call the FICO score. There's FICO scores and FICO scores. FICO score, it was originally Fair, Isaac and Company. They were founded by Bill Fair and Earl Isaac back in 1956. They sought to create a standardized algorithm to calculate rates. Every time you hear FICO, that's all that means. It's a standardized algorithm that lenders can use across the country, across the globe even theoretically, and they can create a standard credit score based on that. There's actually over 100,000 different ways to calculate a credit score. That's not great for consumers. It's not great for consumers because you never know exactly what you're looking at, right? Credit Karma is a great example of this. Everybody comes into my office and like, oh yeah, I got a 900 credit score. I'm like, that doesn't exist on the FICO model. You must be using a different algorithm. And usually it's Credit Karma or one of those Mint or some other kind of score aggregators that tries to predict what your score is going to be. I like those in one way. They're good for predicting like trends of credit scores. If your Credit Karma score is going up, your FICO score is also going up. But it's not great for actually predicting the actual credit score itself. Lenders are going to use FICO Model 8. So it's actually the 8th iteration of FICO. And again, FICO is just created by 2 men who decided to create a standardized algorithm for scores. And the latest iteration of FICO, FICO Model 8, They reduced the impact of medical collections on credit scores. Medical collections were turning out to be very, very common. A lot of times they were erroneous. They weren't actually correct. You know how like every single time you go into a doctor's office, they always ask you to verify your address? It's because medical collections are so common and so prevalent. They want to make sure they're sending the bill to the right place so that they actually have cause to have a collection if the time were to arise. So that's what lenders look at. They all look at FICO Model 8. FICO Model 8 is going to range between 300 and 850. 300 is the lowest, 850 is the highest. The highest I've ever seen is like an 824. It's really hard to be quite literally perfect. My manager called it original sin. Everybody's got something on the credit report that, according to FICO, you could be doing better. We're going to be talking about some of those things. So here's how your FICO score breaks down. 35% of your score is payment history. That's a brunt of your credit score. Over a third of your credit score is simply payment history. Have you made your payments on time? As I mentioned, rank order is based on past performance. If you paid your debts in the past, you're likely to pay your debts in the future. Now, creditors cannot report you late to the credit bureaus until you're 30 full days late. 30 days late. So if you ever miss a payment and you're like, oh no, I got a late fee. Don't stress. Yeah, it sucks to have a late fee. I get it. But don't stress too much until you're actually 30 days late. 30 days late is a problem. 30 days late is going to start to drag down your credit score. So payment history, 35% of your score is that. 30% of your score, which is huge, absolutely ridiculously huge in my opinion. 30% of your score is amounts owed. What this really should say is amounts owed relative to the amounts you could owe. Specifically, we're talking about credit cards. You have your credit limit, you have your revolving balance. That balance to limit ratio is what really, really matters on the amounts owed. Going to be talking about that extensively. It's the single biggest way to improve your credit score. Also, single worst thing you can do for your credit score is abuse the balance to limit ratio on your credit score. We're going to be talking about that in just a few. Length of credit history. How long have you had accounts open? We're going to be talking about that. New credit. This really comes down to two different pieces. One is opening a new account, which we'll talk about the effect there. And then two, having people check your credit. Anytime you have a credit inquiry, it's going to drop your score a bit. And then finally, types of credit used. So we're going to be spending the next several slides discussing all of this, but this is what makes up your FICO score if you're ever curious. So let's talk about the largest portion. 35% of your score is payment history. Simply put, maintain timely payments. Once you're over 30 days late is when the creditors are going to report you late to the credit bureaus. There's 3 specific credit bureaus: TransUnion, Equifax, and Experian. It's like a 3-headed monopoly. To that end, their customer service is just abysmal. If you ever have to contact TransUnion, Equifax, or Experian, strap in. It is not a fun journey. They are a 3-headed monopoly. They know what they have, and they know they don't really have to deliver good customer service. It's kind of brutal. If there's anybody out here that works for one of those bureaus, I'm sorry. The customer service is rough. So with your payment history, if you have an option for a minimum payment, make it. You are much better off. Sometimes I'll talk to people and it's kind of crazy, but they'll say, you know, I had my optional minimum payment, but I really wanted to save up money for a couple months and just pay the entire thing off full. No. Make that minimum payment. Whatever that minimum payment is, make it. It's going to improve your credit score. It's going to keep your credit score intact. Do not have a 30-day late. It drops your score shockingly drastic. And the unfortunate thing is the only thing you can really do is to get current. So again, get current as soon as possible and stay current. Every month that passes, your score will improve after you have a late payment. But that's the only thing you can do is really, there's 2 things you can do. One, you can either contact the creditor and say, hey, I disagree with this late payment, fix it, or throw yourself at their feet. I'm so sorry, I messed up. Can you please just remove the late? They do have the power and the ability to do that, but it's very rare that a creditor will actually do that. So you can either contest it, or you can simply get current, stay current, and wait. Unfortunately, that's the only thing you can really do in that situation is time. Time is your best ally there. Every month that passes, your score will start to improve a little bit. But yeah, if all you do is maintain on-time payments, you're going to have a good score. I've had some people that have had a credit card open for 6 months and they have a top-tier credit score. If all you do is get current, stay current, you're going to have the best credit score you possibly have. All right, so now we're talking about this 30% chunk here, which is the easiest piece for us to really manipulate when it comes to your credit score, okay? Payment history is kind of fixed. Again, you don't really have a whole lot of options there, but amounts owed relative to the amounts you could owe on revolving accounts, you have a lot of control with that. So let's take a look. So credit cards, specifically this is credit cards, almost exclusively credit cards, okay? You really want to keep your balance to limit ratio, so how much you owe versus your limit, to 30% or less in any given month. Okay. If you have $1,000 limit on a credit card, you want to keep that balance at no more than $300 if you can. Okay. Second, you go over 30% of your available limit, your score is going to start to drop. If you ever go over 50% of your available limit, your score is going to plummet. Okay. So try to keep your balance to limit ratio to 30% or less. If you go over 30%, it's going to start to drop your score. Single quickest way to drop your score. If you ever notice a lot of volatility with regards to your credit score month to month, almost guarantee you it has to do with your balance to limit ratios. Single quickest way to drop your score, single quickest way to improve your scores is to keep those balance to limit ratios in check. Now, if you were to just say, hey, look, okay, I understand this now. Nobody ever told me this. That's why we're having this class, right? But if you were ever to say that, oh, well, how do I kind of fix it? Well, passively, if you just pay down your card right now and you leave it at 30% or less, once 30 days passes, your score will improve. Okay. So if you're just passive about it, you make your payment, you pay down your balance, you keep it there 30% or less, you're going to notice improvement in your credit score within 30 days. It's whenever that credit card statement generates, that's the information that gets passed along to the credit bureaus. So a lot of people, what they say is, hey, look, I pay off my credit card in full each month. Well, that's fine. But if you're like most mortals, you don't pay your credit card until the credit card statement generates. By then, it's too late. That information's already been sent off to the credit bureaus. So if you're like most people and you use your credit card for a lot of different things throughout the month, and then all of a sudden that bill comes due and you pay it, that information's already been passed along. So if you ever exceed 30% during the month, information is getting passed along when that credit card statement generates. So one thing you can do is simply pay it down 30% or less, keep it there. Or we can try to do what's called a rapid rescore. So a rapid rescore is where we go to the credit bureaus and say, hey, your information's out of date. You have the wrong information. They made a payment, and we can take that information directly to the credit bureaus. Instead of having to wait 30 days for an updated credit score, we can get an updated credit score within 2 to 5 business days. Okay. So that's what we like to do whenever somebody's like in the time crunch, they're pre-approved, they're trying to buy a house, their credit score took a little bit of a hit. This is a very easy way to improve the credit score. Another thing you can do is pay your bill before your bill comes due. Yeah, pay your bill before your bill comes due. If it comes due on the 1st of the month, log in on the 25th of the month, pay it off in full. That way, when that credit card statement generates, it's going to show $0 balance, $0 payment. That's the information that gets passed along to the credit bureaus, and your score is going to improve. So that's another option, is move up your pay date. Pay it sooner than you're required to do. That could improve your score as well. Another option is increasing the limit. Okay. It's very tricky, especially with like store cards, like a Kohl's card, where they only give you a credit limit of like $300. Oh, great. I go to the gas station one time, I'm going to be over 30% of my limit. Such a small limit. It's very hard not to go over 30%. Totally understand. Totally agree. So if you pay that bill, if you increase the limit, it'll increase the or decrease your balance limit ratio, so long as you trust yourself, right? So long as you're not one of those people that's saying, oh, I'm just going to keep racking it up. Well, if you keep your balance limit ratio, and it's easier to do that if you have a larger limit, it's going to improve your score as well. Kat.
Hi, I just wanted to let the people who are joining in the last few minutes know that if you have any questions, you can drop them down in the Q&A option, and we're going to be answering questions throughout the rest of today's event. So we'd love to hear what your
questions are. I'll finish that sentence for her. Thanks, Kat. Yeah, please ask questions. Nobody wants to hear me talk straight for an hour and a half. So please ask your questions. That'd be great. We'd love to hear your questions. So increase your limit. That's going to make it so you're less likely to creep up over 30%. Pay your bill before your bill comes due, or never utilize more than 30% of your limit. If you're doing any one of those 3 things, your credit score will start to improve. And again, this is 30% of your score. It's a huge chunk of your score. Okay. So if you can do that, it's going to improve your score. All right, let's talk about length of credit history. So one thing you should do, if you can, is establish credit early. That's why they always say that you don't want to close out credit cards. Credit cards tend to be your oldest accounts. Okay. If you have a car loan, it's a finite loan. It's only good for, 5 to 7 years, right? It's very, very short. A mortgage, yeah, it might be a 30-year mortgage, but nobody ever has a mortgage for 30 years, right? They pay it off, they refinance, they sell the house. So keep that in mind as well. Credit cards do tend to be your oldest account. The people I've seen with the highest credit scores are the people with the lengthiest credit history. So if you ever hear somebody say, hey, don't close out your credit cards, that's what they're referring to. Every single time you close out a credit card, it reduces your overall length of credit history. So keep credit cards open, keep credit cards active, make sure you're using them throughout the month, only insofar as you make sure that they don't go dormant and your lender doesn't close it. Okay. You don't really have to carry a balance. That's a big misconception with regards to credit scores. You do not have to carry a balance on your credit scores. You definitely don't have to do that. But you want to make sure that they're not going dormant. Okay. If you have no credit, when we pull credit, it's going to say not applicable. You cannot divide by zero. The credit score does not exist. We cannot run this algorithm. Okay. Once you have a credit card open for 6 full months, or really any trade line open for 6 full months, you will begin to have a credit score. And like I said, I've seen some people with a very good credit score after just 6 months. So if you have one credit card, keep it less than 30% of your limit, your score is going to be pretty dang good once you reach that 6-month mark. It goes from having no credit at all to all of a sudden you have a credit and it all works. 6 months of reporting, that's all it takes. If you do have 10 credit cards and you're thinking about closing one, or 5, right? That's fine. From a lender's perspective, from FICO's perspective, you're better off closing your newer accounts than your older accounts. Now, I can't speak to each of the terms of your credit card. Maybe that's not the best financial decision to make. But all things being equal, if you can keep open at least a couple older credit cards, you're going to be better off in the long run. Okay. And then the last thing, live long and prosper. I can't do it. But live long and prosper. The longer you have credit accounts open, the better off your score is going to be. It's only 15% of your score, but it still makes up 15% of it. I mean, that's pretty significant regardless. So. All right. So now we're going to be talking about this new credit section, and then we're going to get to the types of credit used. So new credit. Every single time a lender checks your credit, it will drop your score by 3 to 5 points. Okay. Now, they do have an exception. And that exception is if multiple lenders of the same type, and this applies for mortgages and car loans. Mortgages and car loans. So if multiple lenders of the same type, mortgages or car loans, pulls your credit within a 14-day window, it only counts as one credit pull. This is called non-deduplication. Okay. They do not want to punish you, a consumer, for shopping around for the best rates and terms. Makes a lot of sense. You're going to hear some lenders tell you, hey, it's 45 days or it's 90 days. That is all incorrect. This is straight from FICO, okay? It's 14-day, it's a 14-day window. So if you are having multiple lenders pull your credit for either a car loan or a mortgage loan, make sure they do so within a 14-day window to make sure that it's not going to double the impact on your score. That impact is 3 to 5 points, so it's fairly nominal. It also only lasts for about 90 days. So it's both kind of nominal and temporary in nature, but you do want to keep them in check. Again, it's only 10% of your score, but it still matters. And again, worth emphasizing, this does not work for credit cards, personal loans, or student loans. Okay. If any of those types of lenders pull your credit, it doesn't matter if it's within a 14-day window. They're going to count it as all different separate inquiries, and all separate inquiries are going to impact your score between 3 and 5 points. With mortgages or car loans, they assume you're trying to get the best terms. With credit cards, they assume you're trying to get multiple credit cards. Okay. So keep that in mind, keep that in check. Don't worry about a lender pulling your credit. FICO has already admitted, hey, look, an inquiry or two in a given year is not going to have a significant effect on your score. All right, types of credit used. So you want to maintain a good credit mix. Now, what is a good credit mix? Theoretically, you should have 3 credit cards for every 1 non-credit card. That's laughable. Okay, that is laughable. You do not need to do this to have a perfect credit score. All right, but theoretically, you should have 3 credit cards for every 1 non-credit card. So if you have a car loan and a student loan and a personal loan, you should theoretically have 9 credit cards. Don't do that. Nobody does that. Nobody needs that many credit cards. You're going to have more headaches than you are going to have a benefit in your credit score. Okay, so do not do that. But I would say a credit card is the single best thing you can do for your credit score. Okay, so credit card is the single best thing you can do for a credit score. It shows a level of discipline that installment loans. Installment loans are your personal loans, your car loans. Credit cards show a level of discipline that those loans do not show. Why would that be the case? Well, with installment loans, you can more easily set them up on autopay, right? Set them on autopay, set it and forget it. Your payment's consistent. You're not managing a balance. It's just constantly getting paid down month to month. Well, credit cards, the balances change. With credit cards, you may not be able to set them up on autopay, or you have to manage a balance. You have to balance your balance to limit ratio. They just show a level of discipline that other types of loans do not show. So it's the single best thing you can do for your credit score. I've always been surprised by when I pull credit and their credit report is filled with only student loans and like car loans and no credit cards, how stuck their credit score is. I've pulled that multiple times and I've been like, why is this person only at 700? They've never missed a payment in their life. It goes down to credit mix. They want to see you have at least 1 credit card Highly recommend at least 2 in case one got lost or closed or went dormant or whatever the case may be. So highly recommend at least 2. 3-to-1 ratio is kind of silly. Don't worry about that so much. It really is a little ridiculous. All right. So we're going to pivot slightly. So that's the credit. Okay. I want to talk about briefly the 3 different types of loans. This is going to be relevant on the next few slides that we're going to be talking about. So beyond the just credit score, we just talked about FICO, what makes up FICO. We talked about how to improve each of your components within FICO as well. But beyond the credit score itself, there's other items that do matter. And we're going to be talking about that in the next few slides. But before I get into that, I want to talk briefly about the 3 different types of loans. Okay. So the first type of loan is what they call conventional. Conventional loans are objectively, and I feel comfortable saying objectively the best type of loan. Okay. They're kind of the gold standard for mortgages. They tend to have the lowest interest rates. They tend to have the cheapest mortgage insurance, as long as you have good credit. They tend to have the easiest guidelines, the most reasonable guidelines of all the mortgages. The mortgage insurance is insurance you pay for anytime you have less than 20% down. We'll be talking about that when we get to the down payment section. But it's temporary in nature, so you don't have to worry about paying it forever. It's objectively so the best type of loan. Conventional financing typically wants to see a 680 credit score. I've gotten approvals all the way down to a 620 before, but it's usually with significant compensating factors. Large down payments, a lot of money left over after closing, a lot of reserves, money left over after closing. Like there's a lot of different things that can improve those compensating factors and offset a lower credit score. But if you read conventional guidelines, they say, we like to see a 680. We'll go down to a 620 if you have other really strong compensating factors. Government loans. We're talking about this a little bit later as well, but there's FHA, Federal Housing Administration, USDA, U.S. Department of Agriculture, and then VA, Veterans Affairs. Okay, these are all 3 truly government loans. It is actually Uncle Sam's money. When you pay taxes, you are funding these programs that then fund mortgages. Okay, so true government loans. With government loans, they typically want to see a 620 credit score or above. You'll find some lenders that will go all the way down to like a 580, stuff like that, but those are fewer and far between. Most government programs want to see about a 620 credit score. Okay, so conventional 680 plus, government 620 to 680. And then lastly is a portfolio loan. Your car loan is a portfolio loan. It is the lender's own personal money that they're lending out. They get to decide what the rates are, what the terms are, what the guidelines are, all that. So I like to think about this kind of like plan A would be conventional. Plan B would be a government loan, typically FHA, unless there's any vets here. And then plan C is a portfolio loan. Portfolio loan, we can make up our own guidelines, make up our own rules within reason. Within reason is also key there. Government doesn't let lenders just kind of go hog wild. What could go wrong with there? Oh yeah, 2007, 2008 housing bubble popping. Got it. So there are limitations what lenders can do these days. It's called like ability to repay. We have to verify your ability to repay the loan, even if it is us taking on all the risk. Okay. So beyond the credit score, there are a few things that matter. If you have any significant derogatory events, these are all going to be rather relevant. Okay. So a foreclosure is where you have a mortgage. You didn't just get 30 days late or 60 days late, but you actually went 90 days without making a payment. Once you go 90 days late, the lender's going to start to foreclose on that house. And they're eventually going to take possession of that house and sell that house if you do not bring it current. Once you have a foreclosure, which is usually judged at the date of the sale of that property, or the date of the foreclosure proceedings being finalized, you have to wait 7 full years to get a conventional loan. That's huge. It's almost a decade long. That's crazy. FHA, our plan B, has more flexibility there. They want to see a 3-year waiting period from when the foreclosure is complete. So 7 years for conventional, 3 years for FHA. One of the big advantages of FHA is their looser credit guidelines. If you have a 750 FICO score, and honestly anything above a 680, we're going conventional, unless we have one of these significant derogatory events, because conventional is the cheaper loan, the better loan to get. But FHA's really area of expertise, sphere of influence, is low credit scores or derogatory events. That's really where FHA shines. So FHA only would require a 3-year waiting period. What about a short sale? So a short sale, we saw a lot of these happen in 2008, 2009, right in that area. What happened was you owed more on your house than the house was worth. Okay, so you owed more than the house was worth. You were underwater. Okay, you could voluntarily go to that lender and say, "Hey, Bank of America." That's where I worked at when I first starting out. Made the smart move in 2011 to switch to elevations. Hey, Bank of America, using them as an example. We owe you $300,000. Our house is worth $275,000. Will you accept $275,000? And the lender may say, well, it's cheaper than a foreclosure because they don't have to pay as much legal fees. We'll go ahead and accept less than what you currently owe. The lender could just force the hand and make them late and eventually foreclose on the house, or they could simply agree to accept less than what is currently owed. They would then sell that house to a third party. In that situation, it would still be a private sale. You would still be the one that sells that property to a third party, but you have to get approval from the lender to accept less. Okay. Deed in lieu is slightly different. Deed in lieu is you give your title to the lender and you say, hey, please accept this. We want out. And then they would sell the property. So you would literally give title to the lender. The lender would then turn around and sell that property. With conventional financing, a short sale or deed in lieu would require a 4-year waiting period. With FHA, again, looser credit requirements, they would only require a 3-year waiting period for each of these. Okay. So beyond just the credit score, you could have a 780 credit score, but if you have a foreclosure, conventional is going to say no, not until 7 years. FHA would say no, not until 3 years. That's why I make the distinction between credit score and the items beyond the score, the derogatory events beyond the score, because those do matter. And you could have a perfect credit score, not likely if you have a foreclosure within the last few years, but you still have to have these waiting periods also be met. Let's talk about bankruptcies. Chapter 7 bankruptcy, that is the most common one. A Chapter 7 bankruptcy is you do not get to keep your stuff. Okay, you do not get to keep your stuff. You just liquidate it all. The bankruptcy court basically takes it all, sells it all. You basically start anew. When you have a Chapter 7 bankruptcy and it's been discharged is the date it's complete. Okay, they would require 4-year waiting period for conventional or a 2-year waiting period for FHA. There are extenuating circumstances where they will allow lower timelines. Those are very challenging to prove. It has to be like a death of a wage earning spouse. I mean, it has to be pretty significant things. I've had people say, divorce, divorce doesn't count. Or, medical expenses may or may not count. It depends on kind of the severity of the issue. So very tricky to prove extenuating circumstances. These are the basic timelines required. Conventional 4 years, FHA 2 years. Chapter 13. Chapter 13 is you get to keep your stuff, but now you're on a repayment plan. So it's like that restructuring of debt that you always see corporations do, right? They don't completely go insolvent. They just restructure their debt. So it's a repayment plan. This one's kind of crazy to me. So conventional would require 2 years once you've completed your repayment plan. That could be 10 years down the line. 2 years after you've repaid all those debts, 2 years after that is when you could be eligible for a conventional loan. That's kind of shocking to me. Like if you've signed up for a Chapter 13 bankruptcy, you were on that payment plan, you lived according to the payment plan, you paid it off. In my opinion, you should be eligible like the second you're done with it. But conventional guidelines, they're backed by Fannie Mae and Freddie Mac. They are government-sponsored enterprise. They don't care what Aaron James Staufer has to say about it. So 2-year waiting period from when it's discharged, that's when it's your repayments have been completed. Or 4 years from the dismissal. What's the dismissal? You do a Chapter 13 bankruptcy, you're on your repayment period, and then something derails it, and then you end up going delinquent on those repayments. Now, all of a sudden, your bankruptcy is going to be dismissed instead of discharged. It's dismissed, and now you have to wait 4 years. 4 full years. So if you were in 6 years into your repayment, and then you failed the repayment structure and the repayment plan, now you have to wait an additional 4 years before you can get conventional financing. Kind of crazy. FHA says simply a 2-year waiting period. 2-year waiting period from when it's discharged or 2-year waiting period from when it's dismissed. Does not matter. It's 2-year waiting period. Okay. What else matters beyond just the credit score? Mortgage late payments matter. If you've had mortgage late payments in the last 12 months, one or more 60-day lates is going to create issues with regards to qualification. They used to have that limit a little bit tighter. It used to be like multiple 30 days late would count. Now they only care about 60 days or more. Okay, so one or more 60-day late within a 12-month period means we're going to have to wait. We're going to have to wait until you have a clean bill of health for those 12 months, and then all of a sudden we can get you approved for a loan. Repossessions and charge-offs. So a charge-off is you owe money to a creditor for so long that they finally throw their hands up in the air and say, hey, we're never going to see this money. We give up. We give up trying to collect our debt. Okay, we're just going to walk away. We're going to charge it off our books. We're going to write it off our books. That's all a charge-off is. They have their income, they have their expenses. They're going to take it as an expense. Okay. With the charge-off, those typically do not have to be paid off prior to getting a mortgage, but it really depends on the amount. They're going to fall into the category of collections, which is not typically required, but if it's in the several thousands of dollars, it likely would be required. Okay, so you may have fought the creditor and won, from a, hey, I don't have to pay this debt anymore. But with regards to a mortgage, you may or may not have to. Really depends on the amount. What happens is we get your application, we get you pre-approved, we run your loan through the automated underwriting system. That automated underwriting system comes back to us and tells us whether or not those debts need to be paid. They tell us very clearly and distinctly which debts, if any, need to be paid off. Too little credit. I've seen that be an issue before. They like a lengthier, they being Fannie Mae, Freddie Mac, FHA, they like a lengthier credit history. So too little credit could be an issue. I've had people that have had an account open for 5 months instead of 6, so they don't have a credit score. That's not going to work typically. We'd have to go with a non-traditional credit report. So too little credit can be an issue. Again, 2 credit cards is really ideal for a lot of portfolio loans, which would be potentially higher loan amounts. They want to see a lengthier credit history. They want to see like 2 to 3 trade lines established for 24 months or longer. So kind of depends on the lender. Again, they're the ones that are setting the rules there. But if they're going with a portfolio loan, they want to see a little bit of a lengthier credit history. Accounts reported in dispute. This is a really common, I'm going to say problem. It's not the perfect word, but it's kind of a problem. So what happens? Something shows up on your credit report and you disagree. You disagree with the creditor that you weren't late. You disagree with the collection, it shouldn't be a collection, or you disagree with even the account. It could be somebody else's account that shows up on your credit report. So you can reach out to the credit bureaus, TransUnion, Experian, Equifax, and say, hey, I dispute this. This is not real. What happens is TransUnion, Experian, Equifax will immediately flag that trade line as disputed, as in dispute. When they do that, when we pull credit, it removes that trade line from your credit score algorithm. Kind of interesting. All of a sudden, they're calculating that algorithm without that disputed account in the equation. Now, that doesn't mean it's wrong. That doesn't mean it's right. That literally means it's in research, okay? TransUnion, Experian, and Equifax are reaching out to the creditor to find out if this is correct or not. That's all a dispute is. After a few months, they might not get a response, or they might get a response saying, no, this is correct. And then they apply the, remove the dispute. Now it's back on your credit report. A lot of people just try to think like, oh, great, I disputed that account. My credit score jumped up significantly. Well, yeah, it's been removed from the algorithm, but that's not always okay from a lender standpoint. If you have too many disputed accounts, typically we can get by with one. But if you have multiple disputed accounts, all of a sudden, Fannie Mae, Freddie Mac, FHA, all of those are going to say, well, just because it's in dispute doesn't mean it's wrong. It could be 2 months from now and they could say, hey, this is all correct. This is all correct information. The credit score should be much lower. So a lender doesn't really know what to do with that. If you have multiple disputed accounts, it can definitely create an issue with regards to getting your loan approved. Just because it was removed from the algorithm doesn't necessarily mean it was wrong. What is your actual credit score? And that's where a lender struggles. Like, what is this credit score? What do we actually think this credit score is? We don't know until we find out whether or not these disputes are accurate or not. So disputing one is okay. Disputing multiple accounts is typically going to create an issue with regards to getting the loan approved. The lender just does not know if the information is correct or not. Credit inquiries. So this one's interesting. So it used to be the cool thing. You would drive the new car to the new house closing when you were purchasing it. And then the housing bubble popped and the government started to ask questions like, hey, that new car loan, did we factor that into the equation when we were calculating their debt to income ratio? And the answer was inevitably no. That's not good. So now lenders are all required to do a credit update, a credit refresh, 7 days before closing to make sure that your debts have not changed dramatically, okay? We need to make sure your debts have not changed dramatically. We also need to find out who's checked your credit since we started the process, okay? Oftentimes, when you're buying a house is when you want to go get new accounts. It's kind of counterintuitive, but when you're buying a house, you're like, oh, I need to go get new furniture, so I probably need to stop into Furniture Row and see if they have any good financing options. I want a President's Day sale at Home Depot and Lowe's. Maybe I can buy a new washer and dryer. Anytime they check your credit because you're trying to extend a new line of credit, we will find out 7 days before closing. And we then have to either show you didn't add that to your open up a new account, or we have to add it manually to your trade lines, your credit report. That can be very tricky. It's very tricky to do that in a very small window. Depending on how much documentation you have, it can be easy. Sometimes it's challenging. So be careful with that. When you're under contract to buy a house, when you've already been pre-approved, try to keep your credit inquiries to a limit after that, because we will find out, we will have to ask questions on why those folks were checking your credit. So next is judgments. Judgments are where you legally owe somebody money. Most common would be like a tax lien. Okay, you legally owe the federal government money. Or we see this one come up occasionally, outstanding child support or spousal maintenance payments. Those would be judgments. You lost a lawsuit. Now that shows up on your credit report as a judgment. All judgments, regardless of what type of loan you're getting, all judgments have to be taken care of prior to or during the process of buying a house. You cannot close on a house while those still are outstanding. Okay, so plan on getting those taken care of. All right. So now we're going to turn our attention to down payment. Again, if you have any questions on credit score, let Kat know. On to down payment. So what is the down payment? It is a lump sum you pay that reduces the amount you're borrowing. Kind of straightforward. It is your personal investment in the purchase. Lenders like to see a down payment because they've done studies which show if you have skin in the game, if you have a down payment in the transaction, you are more likely to pay on that debt. Having a down payment makes you more likely to pay on that debt. You feel like you have ownership of it. Okay, so that's what a down payment is. You're going to hear this term a lot today. Loan to value. It is simply the amount owed relative to the value of the property, and the value of the property is going to be the lesser of either the contract price or the appraised value on the house. The lesser of those two numbers. So the amount owed relative to the amount of the property itself, the value of the property. So if the sales price is $500,000, you have a loan of $400,000. Your loan to value, or LTV, would be 80%. Your down payment is the 20%. Both those together get you up to 100% of the value. So most everybody's heard, hey, you have to do 20% down for a house. There's advantages of doing 20% down. It's kind of the old standard. We're going to be talking about a lot of different options there. So advantages to a 20% down. One, you have instant equity in your house. What is equity? Equity is this 20%. Okay. Equity is the difference between what your house is worth and what you owe on it. It's that chunk. It's that margin right there. Okay. That is the equity in your home. As you pay down the mortgage, you build up your equity. As the value of real estate increases, you build up your equity, kind of passively, but you build up equity. It's the difference between what your house is worth and how much you owe on it. That gap is your equity. It gives you greater buying power because it's also going to have a lower monthly payment. When you have a 20% down, you're not required to have mortgage insurance. We'll be talking about that shortly. Yeah. There's also other options, what they call an 80-10-10 or a piggyback loan, or sometimes it's called a combination loan. Okay. So people got sick of having mortgage insurance and they didn't want to put 20% down because it was a big pill to swallow. So what a lot of people started to do was they started to do a piggyback loan. They would do an 80% first mortgage, 10% second mortgage, known as a home equity line of credit. It would have a higher interest rate. It would have a variable rate on that home equity line of credit, but you could then do like a 10% down payment, 80-10-10, 80% first, 10% second mortgage, 10% down payment. By doing so, you would be able to avoid mortgage insurance. That's one of the biggest advantages of an 80-10-10. You get to avoid mortgage insurance. It also has a lower down payment requirement. Instead of having to come up with 80 or 20% down, you could simply do 10% down. Nice. These were really common. People were sick of paying mortgage insurance. It's the one type of insurance that does you quite literally no good. Okay, it's insurance you pay for that protects the lender. Wait, why would I want that? You're right, you would not. So people want to avoid that if they can. We'll be talking about it in a couple seconds here where we can show how much it is. People have this misconception about how expensive mortgage insurance is. It's not nearly as expensive as you might think it is. There are some downsides though to an 80-10-10 or a piggyback loan. Number one, again, those HELOCs, those home equity line of credit HELOC, they have adjustable rates. They will fluctuate with time. Rates are really high right now. Those rates have fluctuated dramatically. Those HELOC rates today are almost 9%. Yeah, kind of high, not very great. They also can have a balloon payment. So you might have a balloon payment is where partway through your loan term, if a HELOC is like a 20-year loan, you might have the balance of your loan due after like 10 or 15 years, something like that. HELOCs are one type of portfolio loan, which again means the lender gets to dictate the terms. HELOC terms, HELOC rates are going to vary pretty drastically lender to lender. Okay. But they may or may not have a balloon payment. Make sure you're asking your lender if you're going with something like this. And this is the single biggest disadvantage. The government realized if somebody was doing an 80-10-10, now they had to worry about two loans instead of one. Now they had to worry about a higher rate on their second mortgage relative to their first mortgage. So isn't that like overall riskier? And the government started asking those questions. And then when they asked those questions, they said, yes, an 80-10-10 is definitely more risky than just doing like one mortgage. So we're going to charge higher rates now on that first mortgage. The day they started doing that, and it's a pretty significant impact, the day they started doing that, 80-10-10 started becoming far less frequent. We might do maybe 1 or 2 a year. They're very, very infrequent that lenders will do those anymore because the rate they charge on that first mortgage now is so much higher. Used to be a really good strategy, used to be a really good option. Government caught wind of it, kind of saw how lenders were skirting around mortgage insurance, and then they started charging high rates on the first mortgage, kind of killed these off for the most part. They still exist, they still have their place in the world too. There's also other options where you could do like a 40-40 loan, a 40% first mortgage and a 40% second mortgage. Why would I do that? Well, if you're going to sell another house and you want to pay off a chunk of debt very quickly, you could then pay off that 40% second mortgage. There's a lot of different options there. People have gotten pretty creative with them. It's another tool in our toolkit, but it's a less frequently used tool. So the old standard being 20% down, let's talk about the kind of new standard, okay, which is mortgage insurance. Mortgage insurance. Again, one type of insurance that does you no good. You pay for it, it protects the lender. It will cover them the difference between what you put down and ultimately 20% equity in the property. So if you put 3% down, it would cover them from 97% loan to value, which is where you're starting off, all the way down to 80% loan to value. So that 17% is what it would cover them, okay? Max loan to value is 97%. That's if you're a first-time home buyer. First-time home buyer defined as anybody who's not had an ownership interest in a home in the last 3 years, okay? If you have had an ownership interest in the last 3 years, you have to put 5% down instead of 3% down. Okay, so a little bit more, but not too bad. With a conventional mortgage, you can pay it as a monthly fee, a upfront fee, or you can do what they call split premium, which is where you pay a lower monthly fee and a little bit upfront. Okay, with a conventional loan, you can go in any one of these options. With an FHA loan, you have to pay both upfront mortgage insurance and monthly. FHA gets you twice. If there's downsides to FHA, that's one of the largest ones. You have to pay mortgage insurance twice. Also, with FHA, your mortgage insurance is going to be permanent. You're stuck with it forever, which really sucks, okay? And then lastly, FHA is more strict when it comes to the collateral piece. They're much more strict when it comes to the property you're buying. They want to make sure that anybody that's getting a government-backed loan, a true government-backed loan, FHA, VA, that the house is in good condition, that it's up to code, that's in good condition. And their definition of that is a little bit more strict than conventional. Conventional just cares about obvious health, safety, livability concerns. So mortgage insurance is by far and away the new standard. And like I said, it's a little bit cheaper than most people think it is. Here's how much it runs you, okay? So this is for every $100,000 loan amount. So if you were getting a $300,000 loan, multiply these by 3, okay? $400,000 loan, multiply these by 4. This is for a 740 plus FICO score. And these are the amounts that I know I can get it for. And when I say that, I mean there's a very good chance we'll get it less. All mortgage insurance companies offer lenders the exact same protection. Okay, there's no difference at all between one mortgage insurance company and another. They offer us all the exact same coverage. So we shop it around 3 times during the process. Once you're under contract, when we get the appraisal back, and then prior to closing, we want to make sure that you are getting the cheapest mortgage insurance. It's of the utmost importance to us. It's one of the few arenas where I can really save a member money and it doesn't cost anybody anything else. There's no advantage to me using one company or another. Every single time I'll get a call from a mortgage insurance company and say, hey, haven't seen many orders from you lately. Just curious why. I'm like, it just comes down to premium. It just comes down to premium. This is not car insurance. This is not homeowners insurance. We do not care who the insurance provider is. All we care about is who's cheapest by a nickel. Okay. So these are the amounts I know I can get it for. Let's assume you're paying it on a monthly basis. That's the most common route. And it's the most common route because of what I'm going to show you on the next slide here. But 3% down, $690 per $100,000 loan amount per year. So if you had a $400,000 home, you'd multiply that by 4. And then you divide it by 12 to come up with your monthly premium. So in that situation, it'd be like $230 per month. $690 times 4 divided by 12. And that's a 3% down scenario at $400,000. From there, 5% is going to be less, 10% even less, 15% even less. Okay, so the more you put down, the less it is. Yay, Kat, first question.
Hi, yes. So our first question is, if I already have a high credit score above 740, is it worth getting a second credit card? If you think so, why?
Yeah, that's a great question. My natural inclination would say yes. If that card became dormant and they had to close it out, you would now have a single point of failure. I've seen this before. People have had trade lines before, then they close them out. They're consolidating debt, they just pay them off, they close them out. After 6 months, you will no longer have a credit score. Your previous track record does not matter in any way, shape, or form. Okay, so 6 months of having no trade lines open, your score goes to 0. Cannot divide by 0 again, does not exist. You cannot divide by 0. I like 2 credit cards only from, hey, it's going to improve your score after 6 months. And 2, it is a single point of failure if you only have 1. it goes dormant, it gets closed, you lose it, you have to open up a new one. All of that can negatively impact your credit score pretty significantly. It's not that you're necessarily going to see huge benefit of it. It's more of a safety net, really, honestly, more than anything else. So if you trust yourself, then yeah, one's going to be fine. Yeah, so there's no wrong way there. I like having at least two, so that I have a little bit more diversification with my trade lines, in case one did close out for any reason. Banks fail. Banks fail. Creditors fall out. Creditors close up shop. If that happens, you're losing your credit card. Like, that wouldn't be good. Your entire credit history would disappear. So yeah, I would say yes, but it's not a huge priority. I would also say if you're trying to buy a house in the next 6 months, don't do it, because it's going to drop your score. Once you get a new account, it's going to drop your score for about 6 months. After 6 months, it'll start to help you. For the first 6 months, it's going to pull you back. And if you're trying to get any other loans, mortgage or otherwise, I would say don't do it. Great question. Love that question. Keep them coming. So here's the 3%, 5%, 10%, 15%. People always ask the question, well, could I put 4% down? Yes, you can, but it's still going to be at the 3% down rate. Okay. There's no advantage to reducing the mortgage insurance rate until you hit these various different levels. Also, once you get it, it's going to be at this rate until you get it removed entirely. Okay. So people are like, well, I've been paying down my mortgage. I think I now have 15% equity. Does my mortgage insurance go from 690 to 190? Nope. If you put down 3%, it's going to be at this rate until you get it removed entirely. Hey, Aaron, how do I get mortgage insurance removed? I'm so glad you asked. So with a conventional loan, there's 4 different ways to remove mortgage insurance. Number 1, it'll fall off when you are scheduled to reach 22% equity. Okay. That is when you're scheduled to reach. Scheduled is key. Okay. That's not when you do reach. That's when you're scheduled to reach. That is the worst case scenario. Okay. That is you fall asleep at the wheel. You make your payments on time. It'll fall off when you're scheduled to reach 22% equity. If you did 5% down, it might be 10 years into the transaction. Okay. So that's, again, worst case scenario. Don't worry about that one. It's very infrequently used. The other ones are much more likely to happen. Number 2, you can refinance. Not only can you refinance, but you're almost certainly going to refinance if you're buying a house in 2024. Okay. The running joke right now is you marry the house, but you date the rate. Okay. Whatever interest rate you're getting right now, you're going to be refinancing in the near future. People are like, well, I don't want to buy a house right now. Rates kind of suck. They're almost at 7%. True. But what if you only have that loan for 12 months, 24 months, 36 months? All of a sudden, it's a little bit less consequential. People get it in their head, I'm signing up for this for 30 years. No. We'll be refinancing you within a shorter period of time than that. When you go to refinance, if you have 20% equity in your house, you will not have to have mortgage insurance on that new loan. That one's kind of obvious, right? You have 20% equity on the new loan, you're not going to have mortgage insurance on that new loan either. Number 3, within the first 2 years, if you actively pay down your loan and you reach 20% equity based on the original value, you can petition to have it removed. It says lender's discretion. I say petition, same thing. It really means you have to pay for an appraisal. Okay. You have to pay for an appraisal to make sure your property has not gone down in value any. Okay. Within the first 2 years, they will only use the original value, the lesser of your contract price or the appraised value. Okay. They will not use any appreciation within the first 2 years. And you have to have 20% equity or 80% loan to value. Lastly, probably the most common route right now. Although I think number 2, refinancing is going to be the more common route in the next couple of years. But number 4 is most common right now, which is after 2 years, you can petition to have removed based on a new value, based on an appreciation. Okay. After 2 years, they'll use appreciation. Within the first 2 years, they will not. Again, it's on request and it's at the lender's discretion, which means you have to pay for an appraisal, find out what the house is worth, and then you have to have 25% equity. Why scheduled to reach 22%? Why do I have to have 25% here? Like, why is it not just a 20? It's a good question. One thing I know of all insurance companies, regardless of the industry they serve, is that they like their money. Okay. They're also really worried in the 25% equity situation, since we're using appreciation, that you might be in a volatile market like California, where they see significant increases in values month to month to month to month. They don't want to hang their hats on any single one well-performing month. They want to have a little bit of a buffer built in there. Insurance companies love buffers, 25% equity after 2 years. So let's talk about acceptable sources of down payment. Cash is not acceptable. Okay. It's one of the only times in your life where cash is not okay. Why? Well, it's kind of crazy, but all these loans are backed by the government in one way or another. Conventional, those are backed by Fannie Mae and Freddie Mac. Those are government-sponsored enterprises. They are under the umbrella of Federal Housing Finance Agency. Okay, that happened after the housing crisis. The umbrella popped, and they said, "Uh-oh, that's not okay." So they brought Fannie Mae and Freddie Mac underneath their umbrella and said, "Okay, we're in charge of you guys now." So Fannie Mae and Freddie Mac are government-sponsored enterprises. They're sponsored by the government. FHA, VA, USD, those are all government loans. Okay, portfolio loans. Hey, Elevations Credit Union, they're not the government. Yeah, true, but we have NCUA insurance, government. So we're all backed by the government in one way or another. Okay, and anytime it's a financial institution that's backed by the government, they want to make sure that the money you're using for the down payment was legally obtained. That's why they hate cash. Cash is tricky. Cash is tricky. There's no paper trail on cash. Okay. If you got cash tips as a waiter or waitress or bartender, right? There's no way to prove that there were cash tips unless you're claiming it on your, pay stubs, right? It could have been that well-earned, legally earned money that you're paying taxes on, maybe. Or it could be you sold drugs and now you're trying to buy a house with drug money. That's truly what they're worried about. They're worried about Breaking Bad. That's exactly what they're worried about. Okay. So we need to show the paper trail. We need to show the paper trail. So if you do have cash and you want to buy a house, you need to season the funds. Okay. You need to get them deposited in a bank account and you need to leave them for 2 full months. Same applies if it's precious metals or collectibles. Anything we cannot get a paper trail on, you need to sell, you need to get the funds deposited, and then you need to wait 2 full months. The seasoning of funds can cure all these woes. Okay. It's money that was acquired more than 2 months prior to going under contract. When you go under contract, we ask for the most recent 2 months of bank statements. 2 months of bank statements. Anything that happened before those 2 months is not my concern. I'm not worried about it. I'm not concerned about it, nor should you be. Okay. So if you do have cash, and this comes up regularly, I talk to some members all the time. They're like, yeah, I got $40,000 for a down payment. Fantastic. Where is it sitting? In a safe at home. Not fantastic. Deposit that money. Deposit that money. Wait 2 full months, and then you can go under contract on a house. Very, very infrequently have I been able to use cash deposits as a source of down payment. And when I was able to get some kind of paper trail on it. So yeah, keep that in mind. Cash, not okay. Raw goods. I've had people sell gold before. I've had people sell artwork before. All that's fine as long as you can prove you own it and show the paper trail on it so that the government feels comfortable using it as a source of down payment. Ultimately, you want your funds in the form of a liquid bank account for closing. Savings, checking, money market, all of those are considered bank accounts. We're going to get the most recent 2 months of bank statements on those accounts. Any large deposits, anything more than 50% of your pay, we have to find out where it came from for that exact same reason about the cash. They want to make sure that it's legally obtained funds and there's no trickery going on with it. Gift funds, perfectly fine for the purpose of down payment. It's money given from a relative towards a down payment. It can only be gifted from somebody that's a relative or familial-like relationship. The government eased up on that slightly. They used to say strictly blood relatives, grandparents, grandfather, does not matter. Aunts, cousin, nephew, spouse, all that was perfectly fine. They add familial-like relationships to identify a couple scenarios that have been coming up. Fiancés, great, that makes sense. We don't have to see the ring either. We don't have to see the ring and say, hey, are you really married? Let me see that diamond ring. No, it's literally you filling out a letter saying, yes, we are fiancés. Okay. Also, ex-spouses, that used to come up all the time. Somebody would go through a divorce. One parent would have, primary custody. So they'd be buying a house for them and their child. And then the ex-spouse still wanted to help out. Great. The government allows now for familial-like status. Ex-spouses count towards that. Adopted children also count as well. So that's another exception that the government's recently allowed. It has to be a gift. It cannot be borrowed. Okay. A gift is critically important for the purpose of this. They will sign a letter saying that this is a gift, not a loan. This is a gift, not a loan. We do not expect repayment. Then we have to show the transfer of the funds occurring from their account into your account or from their account to the title company. Copy the check, copy their bank statement, a wire receipt showing the money leaving, whatever is relevant for that situation is what we're going to need. We really like going the wire route. The wire receipt has all the identifying information. It makes it really, really nice and clean, but we'll take whatever you can get us. Okay. Now people always ask about the tax consequences of gifting money. We do not have any limitations on gifts. Okay. We also do not report gifts to the IRS. So talk to your CPA about any limitations you might have. They would only find out about it if you're reporting it to them. We do not report gifts to the IRS. Cool. All right, so secured loans. So secured loans, that is a loan taken against an asset you own. Very common version is a retirement account, okay? So you have a retirement account, you have a 401k, you want to take a loan from that 401k and use that money to buy a house. Yeah, that's absolutely permitted. They allow for secured loans to be used as a purpose of, as funds for a down payment. If you have a car and you don't have a loan on that car, you could get a cash out refinance on that car and use that money to buy a house. Perfectly fine. Whatever loan terms there are, whatever repayment terms there are, I have to factor into your debt to income ratio, okay? So I'm gonna have to take that payment, and when I'm calculating how much you can qualify for, I have to take that new payment into consideration. We also have to show the transfer of the funds occurring into your bank account, and again, show that paper trail. Kat, another question.
Absolutely. I currently own a home with a very low interest rate, but am considering moving in the next couple of years. Any thoughts or recommendations about keeping the current house as a rental and buying the new one?
Ooh, it's a great question. It's a fun question. So when you go to sell a primary residence, they're going to ask you a few different questions, okay? Number one, have you lived in the house 2 of the last 5 years? Which I remember asked that question. I'm sure they're nodding. 2, did you sell any other primary residences in the last 5 years? Okay. And number 3, did you use the house as a business? They're not saying, did you work from home during the pandemic? Like I currently am, right? I'm at home right now because our office is closed. They're asking, did you convert your house into a daycare facility? Did you convert your house into an auto repair shop? Okay. As long as you can say, yes, I have lived there 2 of the last 5. No, I did not sell any other primary residences. And no, I did not convert my house into a business. You would be able to protect $250,000 in appreciation as an individual, or $500,000 as a married couple, completely capital gains free. It's really important. I mentioned that because if I'm looking to move into a different house, I may or may not want to rent out my current place. Number one, I'm looking at what are the potential capital gains implications. Once you convert it into rental, you could do it for 2 years, still say, yes, I've lived there for 2 of the last 5. Second, you reach year 3, you can no longer say I've lived there 2 of the last 5. You're now going to have to pay capital gains if you decide to sell the house. So if you do convert it into a rental, I'd go in long-term or very, very short-term, 2 years, 2.5 years max before I try to sell that house. I want to make sure that if you're going to sell that house, you're not going to be doing so in year 4 and having to pay a whole bunch of capital gains that were unnecessary. So that's one big consideration. Second thing I would ask you is, does your current house make a good rental? Not all properties make good rentals. I have a few rental properties myself. I've always gone with what I consider to be ideal rentals for me and my situation. Those were townhomes, low maintenance, easy to take care of, 3 beds, 2 baths. They rent out very easy. If it's a large detached home, it's going to be hard to rent out. You're going to have more tenant turnover. The risk is higher because the damage that can be done is significantly more. All questions that I would ask and debate. If I do turn in rental, it's either 2.5 years or less, so I can protect my appreciation, or it's forever. That's kind of what I would do. Hopefully a little bit helpful, but probably doesn't cover all the questions. Happy to discuss offline as well. So great. Liquidation of assets. You can certainly sell your assets and use that money to buy a house. They're your assets. Stocks, bonds, mutual funds, retirement account. You could liquidate all of those and use that money to buy a house. We have to show a bank statement or an account statement prior to you liquidating the funds to show proof of liquidation, and then we have to show them showing up in a liquid account. Perfectly fine. You don't have to have them liquid when you go to apply for a mortgage. We would just have to show that they've been liquidated prior to closing. Okay. All right. Sale of personal property. This is trickier. Okay. So this is a lot of cash transactions that show up on bank accounts. I've had people sell stuff at a garage sale before, and then they all receive cash. Nobody had the square to be able to run a credit card at a garage sale. So they're all paying cash. That's going to be a problem when you try to deposit that money. If it's more than 50% of your pay, we have to find out where it came from. And if you try to get around it by saying, hey, we're just going to do multiple smaller deposits, underwriters are immediately going to catch wise to that and immediately going to ask where that money came from. So unless we have evidence of ownership of the asset prior to the sale, very tricky. Nobody's got title to their couch that they're selling. We also have to have a bill of sale or proof of the transaction selling. This comes up oftentimes with cars. People are like, they sell their car privately and they're like, oh, I just received a cash for it and I don't have any proof that they took title. That's a huge problem. We no longer have proof that you sold the car. So we need to really show that paper trail occurring. I've had people sell artwork before. They were selling artwork that they had purchased. selling that. Luckily, we were able to show that paper trail. They had proof of purchase, proof of sale, and they received a check, not cash, and we were able to tie the numbers together and make it all work. We also had to get like a Kelly Blue Book value of their cars to show that you received fair compensation, or Sotheby's auctions to show how much that artwork goes for. Like, we've gotten pretty clever over the days and years trying to figure out how to make all the paper trail work. But yeah, there's certainly some limitations there. Document is very, very key. All right, so let's talk about the government-sponsored programs real fast. We've been spending most of our time on conventional. I want to take just a few slides and talk about the other types of loans. Number one, VA. So VA is a really good loan for vets. Those that are currently in service or those that have been discharged honorably are eligible. There's an upfront funding fee. They do not charge mortgage insurance, which is great, but they do charge an upfront funding fee unless you're disabled with a VA. Okay, if you're disabled with the VA, they're no longer going to charge you an upfront funding fee, which is great. If you do have disability with the VA, VA loan is a wonderful loan. If you don't have disability with a VA, then it's going to be kind of a comparison to conventional and which one is ultimately going to serve you better. VA does allow for up to 100% financing. That's a great loan. Downside of that is if you do 100% financing and you have a VA funding fee of 3.3% that you roll into the loan, you might owe 103.3% on your loan on the value of the house. You were starting off underwater. So make sure you're planning accordingly. Make sure you're going to be in that house for a number of years to recoup that money. Make sure that you're going to come out ahead. It's really, really painful when I see vets doing this 103.3% financing, and then they move to a different state and they have to sell that house and they are, losing money on it. So keep that in mind. Again, in place of mortgage insurance, they only have to worry about the VA funding fee. The VA funding fee will vary depending on how many times you've used it before, as well as whether or not you're disabled and how much you're putting down. All of that matters with VA. FHA, probably more relevant for most, unless we do have any vets here, in which case, thank you for your service. But FHA, so it requires as little as 3.5% down. You do not have to be a first-time home buyer. FHA used to be a first-time home buyer loan. That's really how it was viewed. If you're a first-time home buyer, you should really look at FHA. It's no longer the case. Now FHA is really like a low credit score program. Conventional, the gold standard for loans, requires 3% down. FHA requires 3.5% down. So slightly larger down payment. Mortgage insurance is required. It's required for the life of the loan. It's extremely expensive in that way. Okay, much more expensive monthly, much more expensive upfront. They charge you both monthly and upfront. They get you twice. So that's why FHA is, a less, stellar loan option. We go this if we have to. We go this if we do have credit score that's, a little bit lower, or there is a significant derogatory event. But for the most part, we try to go conventional when we can. FHA just has, again, higher costs, higher down payment, and mortgage insurance is permanent, so not great. And then USDA. We do not do a whole lot of USDA loans in Colorado. I'm going to show you why in just 2 slides here. But it's designed to help low-income households buy properties in rural areas. That's the big one, rural areas. We just don't have a lot of areas along the Front Range that are considered rural. I'll show you a map in a couple slides where you can see exactly what those areas are. It does allow for 100% financing. That's amazing, great. Instead of having mortgage insurance, it does have a guaranteed fee, kind of like the VA funding fee. So what you're noticing is all these true government loans, they have extra costs, okay? FHA, upfront mortgage insurance, and higher monthly mortgage insurance, VA funding fee, and then USDA guarantee fee. So they all do have higher costs. The government honestly did this intentionally. They don't love doing mortgages. They tolerate it. They want to help people out if they're low income buying in rural areas, or if they're a vet, or if they're a first-time home buyer with lower credit score. They want to help out all these individuals, but they don't want to do it for free. Okay, so they've caused their costs to really increase over time. It's made all these loan programs a little bit less appealing than they used to be. It also requires an approved lender. USDA is a little bit of a niche loan. Not a whole lot of lenders will do it. And the reason USDA is pretty rare here is because it's only eligible in certain areas. So all of these orange areas are ineligible. So Boulder through Longmont, through Westminster, through Brighton, and then when you get further north, Fort Collins to Loveland to Evans to Greeley, all those areas are ineligible for VA financing, or sorry, for USDA financing. Well, guess what? That's where the brunt of the homes are. So it's just not very common. And then you get into the mountains and you're like, okay, great, you get a USDA loan up in the mountains, but there's so few homes for sale in the mountains. So it's a little bit tricky. Beyond just the down payment requirements, the credit score. There's also down payment assistance programs. Now, here's what happened with down payment assistance. So 2007, 2008, talked about it a few times, the housing bubble pops. Housing bubble pops. The government, federal government, started to offer down payment assistance, okay? They started to incentivize home buyers to go buy homes. And they were doing so by offering it to first-time home buyers, okay? You did have to be a first-time home buyer to qualify for those programs. The first home I ever bought was in like 2009, I think. And it was, I got to take advantage of Uncle Sam's first-time home buyer program. They were trying to incentivize people to buy because there's so much real estate on the market, not enough buyers. They really wanted to gobble up that inventory. They were literally cutting checks to people for $8,000 to go help with the down payment and buy a house. It was amazing. Once a couple years passed, so a couple years went by, the government realized, hey, look, we no longer really have to incentivize people to buy. They're just buying on their own, okay? So the down payment assistance program shifted from the federal government down to local municipalities. States have what they call bond programs. We're going to be talking about one of those next. Cities have their own down payment assistance programs. Denver Metro has their down payment assistance programs. Boulder County has their down payment assistance program. It became much more kind of municipality related down payment assistance program. Went from federal down to the state, down to the municipalities. And then the other thing that happened is it went from first-time homebuyers down to low to middle income households. Most down payment assistance programs no longer require you to be a first-time homebuyer. Some do, a few do, but most require you to be making less than the area median income. Some say less than 80% of the area median income. So they really went from first-time homebuyer programs to low to middle income household programs. They almost always will require some kind of homebuyer education class. So let's talk about the biggest one in Colorado, which is CHFA, CHFA, Colorado Housing Finance Authority. If you're ever down at a Rockies game, if you look across the street, you'll see a building with CHFA on the side. That's their headquarters. So CHFA was created in 1973 to address the shortage of affordable homes. They offered a variety of programs to lower the down payment. Also, they have lower mortgage insurance. That's another perk of it. They do have income and purchase limits based on the county. And income is critically important there. They are going to limit how much you can make. If you go to chfainfo.com, it'll come right up with their income limits. They're actually pretty high. Now, CHFA is, I tell people kind of in short summary, if you're buying a house and you have a down payment without needing CHFA, do it, okay? CHFA has higher upfront costs. They're going to charge you 1 point, so 1% of your loan amount as a fee to get a CHFA backed loan. Most of the CHFA down payment assistance now is loans, not grants. Most of them are loans, not grants, which means you have to repay that loan when you go to sell your house. So higher rates, higher costs, but it can shrink your down payment all the way down to a few $1,000s. So if there's a difference between renting and buying, go CHFA. You'll refinance down the line. We'll take care of that for you. We'll get you out of CHFA when we can. But it's certainly better than renting, okay? If you don't need CHFA, if you got the 3% down on your own without causing heartache, without causing you to lose sleep at night, go that route instead, okay? CHFA will end up with the mortgage after closing. So we would originate it, we would close you, and then after closing, you would work with CHFA directly. CHFA is the one that receives the servicing rights on the loan. They're the ones that you make your payments to. The interest rates are typically between 0.25% and 0.75% higher. I pulled their rate today, and it was at 7.25% as of quite literally today. So the most common CHFA loan is what they call a CHFA Preferred Plus Second. CHFA Preferred Plus Second. What CHFA will do is they will loan you 4% of your loan amount towards your down payment. So you'll do 3% down. CHFA will then lend you 4% down. They charge you a 1% origination fee to do a CHFA loan, and then you have your closing costs and prepaid expenses. All in all, you'll typically get to closing with somewhere between $3,000 and $5,000 being needed for closing. So not a bad deal. Again, better than renting. But if you don't need it, you're better off avoiding it because of the higher interest rates and higher costs. Again, they're going to charge you 1%. You'll hear it called a 1% origination fee. It's basically the lender charging you a fee to do the loan. Okay. So not a bad loan, certainly worth looking into. chfainfo.com. They do require a home buyer class being taken. It's actually a worthwhile class to take regardless. It's pretty useful. That certificate is valid for 12 months. So if you get a CHFA certificate, you can use CHFA's down payment assistance for the first 12 months. After 12 months, you have to take it again. All right, Kat, that is pretty much it. If anybody has any questions, Kat and I will hang out. Yeah, hope you all found this useful and helpful. as you can tell, hopefully I really like the education part. So yeah, if you have questions afterwards, grab my email, grab my cell phone, reach out to me, however I can help you.
I don't have any questions just yet, but as you
Okay.
said, we can hang around a little bit.
Yeah, we'll hang out for a couple minutes. If you think of anything, let us know. Not seeing any questions. All right. Well, thank you all for, oh, there's a question. Of course, the second I that. Oh, not a question, just a comment. Thank you. This is a good presentation. You are very welcome. Thank you for attending. If you have any other questions, let us know. Appreciate you.
Thank you all.